And joining me now to discuss some of the other big stories of the day are Kevin Mond, CIO, Hennian and Walsh Asset Management, and Jeffrey Taylor, co-founder of Digital Risk. Good to have you both here with us.
Thank you.
We want to start with President Obama. He wraps up his historic visit to the Middle East. Fundamental change is underway there in the Kingdom of Saudi Arabia as well. Under the leadership of the 31-year-old Crown Prince, Prince Mohammed bin Salman, the Gulf state is restructuring to reduce its dependency on oil. It's all reining in wasteful spending. And according to Bloomberg, the numbers are staggering. Some $100 billion per year was being wasted. And it gets worse. The Saudis realized last year they'd be effectively broke by early 2017. All right, what changes, Kevin, are they making there now to stem this hemorrhaging of cash?
Yeah, I mean, Alexis, being the patriot that I am, I take somewhat of solace in this report. Saudi Arabia has controlled the oil markets for the better part of the last 2 decades. Over the course of the last 2 years, they've been waging war with the American energy renaissance movement, specifically fracking. They've been keeping production artificially high, making oil prices stay lower, even though they haven't been profitable. We've always questioned at what point in time can they actually cut back on production so they can start turning a profit again. It looks like that moment may have passed, and that's a good sign for opportunities in the U.S. energy market, specifically as it relates to natural gas as well.
Well, the Saudis are still responsible for the world's largest supply of oil. So how do these changes affect the oil industry? I mean, you're alluding to some of that right now, Kevin. But
yeah, I mean, if you look at it, but basically they had a business model, it's also like not a monopoly, but for 20 years it was the same thing over and over again. And go bigger picture here. How many industries are being disrupted by new technologies, new strategies? So they basically woke up one day and said, look, we really have to, we're going to be broke if we don't start diversifying. What's really interesting, and Kevin alluded to it, is the state of Iowa right now, their electricity, 65% of it is based on windmills right now. So there are other technologies coming into the world, especially the country, and price points getting there. It's not all going to be relying upon oil, and I think it's waking up and realizing that. So it's how do I diversify? How do I start focusing on other areas?
So is this sort of a humbling time for the Saudis? I mean, they just took out a huge loan, right, for the first time in well over a decade.
Yeah, I mean, on your point before, the U.S. is now the largest producer of crude oil and natural gas in the world. Not the largest exporter as of yet, but the largest producer of crude oil and natural gas because of our innovative technologies as it relates to fracking. Saudi Arabia realizes this. Their national interests are at risk here. So they need to diversify and pivot away from just relying upon crude oil alone.
So them not trying to diversify, Jeffrey, will this now just mean more opportunity for people who just couldn't get into this industry?
Well, again, right now, the prices where oil is trading at right now, I'm not sure I'd be wanting to jump into the industry, but I think what it does diversify is other opportunities. Again, back to windmill power for energy.
So alternative
energies right now. That's the big play I'm following going forward right now because, again, we're producing the most oil in the world right now. But, again, there's going to be other technologies and other forms of energy that are going to really drive the next 30 or 40 years. Oil is extraction, but if you can create energy
and
but use the wind to harness it, that's a game changer.
All right, moving on. Comcast is firing back at the FCC and President Obama. Last week, the Obama administration and the FCC made a push to force cable operators to decouple TV service from the proprietary set-top boxes. Yahoo Finance's Nicole Sinclair sat down with the president to discuss his proposal, and here's what he had to say.
The more competition we have, the more products, services, innovation takes place. And the sort of the cable or satellite box is just one example of an area where because it's been tied to the provider and you rent it and consumers spend billions of dollars on this every single year, there hasn't been much innovation.
Well, now Comcast is making its full cable line available on Roku and Samsung smart TVs without forcing customers to lease its set-top box. Wow, I mean, is this a win for the president and the FCC here? Because it did force some change and some innovation.
I just really don't think the federal government needs to be a part of this argument. I think the market is moving in this direction already. You look at Hulu, you're looking at Amazon, you're looking at Netflix. The consumer is already demanding more accessible means of media. The fact that now the government is stepping in and telling the cable companies what they should or shouldn't be doing, which is still private industry, I believe, doesn't necessarily help the overall equation, I don't think. Did it help? It may have helped, but is it going to help down the road?
You're nodding your head, Jeffrey. You agree with this? I mean,
I agree with it. I mean, look, it's great that the president has his opinion on this. Bottom line is competition and survival is driving this.
That's
so when you
really
get that same content on Netflix or the other portals, they're already there. Comcast knows. I mean, we see all the commercials with the ancient Comcast company and DirecTV or Dish TV. They get it. They've been working on this. So to survive and be relevant, going forward, they have to do this.
Right, because this deal that Comcast has struck with Roku didn't just happen since the president spoke.
Right.
This was in the works. Perhaps this prodded them to come out with this announcement a little sooner, perhaps?
Perhaps.
Yeah.
Perhaps. And I saw an announcement this morning that some of the bigger channels are now coming off of Dish and being sold exclusively to some of the cable companies. This ongoing debate between digital and the hardwire cable isn't going away. But again, I don't think the federal government needs to be involved.
Yeah, if I had to bet, I think the board of directors of Comcast was much more in the CEO's ear than the president making his statement right now. So it's a nice statement, but again, it's very clear sort of where we're going as an economy and digital and what they need to do to provide content and stay relevant. So that's the driving force.
Do you think that open standards for set-top boxes are still needed? Even in this, I mean, even if customers can now access their cable lines through apps?
I think that's up to the cable companies and what the consumers demand. It's all demand and supply.
Okay.
And I think it's interesting that the president got involved in this, but I think at the end of the day, it's the consumers that's going to make.
And it's not just this industry. That proposal is going to affect a number of different industries. Cable was just sort of the first one they targeted.
It's also going to be like, how can you get as much content with paying one access point, right? So you're going to see more and more consolidation, more piping per se, to be able to come in and maybe pay one subscription and get as much content as possible. Now, how that throws off the advertising industry and other things, that's sort of TBD. So they better be very nimble also how they're going to get their message across and revenue generated. But that's where all this is going.
Yeah, and one bill for the customer, of course, would be the goal, just to make things easier. All right, finally, the road warrior seems to have a new habit. Uber. According to data from expense management software firm Certify, Uber now accounts for 43% of ground transportation expenses last quarter, with rental cars now at 40%. This trend began in the fourth quarter of last year and has really only grown from there. So while Uber's effect on the taxi industry is more obvious, do you think it's surprising that these ride-hailing services are now getting a run for their money from Uber?
I don't think so. I know when I travel, as we were speaking about before, I use Uber now more than I rent cars. Because when I'm in a different place, a place I'm not familiar with, I'd rather trust the local knowledge of a local driver to get me from point A to B than add the additional stress of trying to find the building I'm trying to get to and not be late for the meeting. So this doesn't surprise me at all. I think it's all part of the Uber wave.
And is it about convenience at the end of the day?
I think it's convenience. I think it's cost. I mean, look, 4 years ago, I think I rented cars 50 days, 1 year traveling. And on my 1,600 employees, many of them travel to go see their clients. We would much rather get in an Uber from point to point on a time, knowing you're going to have it within 5 or 6 minutes, get there. And also a little bit socially and being responsible. If I have my team going out on a business dinner, they might have a few cocktails. I'd rather have somebody driving them back to where they're going to go versus potentially saying, well, I rented this car, now I have to take it home. So again, I think that Uber, that model is absolutely changing the way business travel people think.
Now, what about from an investor's standpoint? Are these rental car companies, Hertz, Avis, and the like, hurting right now?
I think they're going to need to start innovating as well. Just as we were talking about with the cable companies needing to innovate to stay relevant, I think the rental car companies are going to need to do the same. We're seeing that chip away at the Taxi and Limousine Commission. We're seeing it chip away at the rental industry as well.
You know, I just got a couple of examples for you. Enterprise has introduced a card share program to offer customers hourly rentals, right? So it's trying to be sort of like maybe a zip car situation, but not really. So they are morphing into something else. Hertz also just invested in a Silicon Valley startup that offers on-demand parking services via an app. So they are really forced to innovate now.
They're forced to innovate. And again, I think if you look at the leisure market, I think that the rental car companies still have a period of time where it makes sense if you're renting for a week and you're taking your family. Okay, that makes sense. But if you're going to compete in the business market right now, I mean, renting a car is literally not top of mind when I go someplace. I know I can either get a cab or an Uber in that real-time experience. So they're going to have to reinvent their model, or they're going to be extinct.
Isn't the business traveler really who they're after, what the airlines are after? Because that's really where the money is.
That's where the must go. Those are the must go people. So that's absolutely where the real money and revenue comes from.
All right, Jeffrey and Kevin, thanks so much for being with us today.
Thank you for having us.